and welcome back to Prime Wealth. If you're tuning in today, you're in for an insightful discussion about a strategy that can really change the game for your retirement planning.
Absolutely, Jordan. We're diving into the retirement bucket strategy, which is all about balancing your short-term and long-term needs. It's such an important topic, especially for those of us over 40 who are thinking about what retirement really looks like.
Right. And it's not just about saving money. It's about how to allocate those savings effectively. We'll break down how to create those buckets so you can have peace of mind no matter what stage of retirement you're in.
Exactly. We'll cover the basic philosophy behind the bucket strategy, how to decide what goes into each bucket, and some practical tips on managing those investments over time.
And I think what's really exciting is how this strategy can help you feel more secure and in control of your financial future.
Yes, it can make all the difference. We'll also touch on some common pitfalls to avoid so you can steer clear of those mistakes that might derail your plans.
So stick around as we unpack this approach and help you think ahead in a way that feels manageable and achievable.
Let's get started.
And you know, Alex, with so many people over 40 starting to think seriously about retirement, this is just such a crucial topic. The idea of having a solid bucket strategy feels especially relevant right now, doesn't it?
Absolutely, Jordan. I mean, the reality is, many folks in this age group are facing a unique set of challenges. With increasing lifespans, it's not just about having enough to get by for a few years after retirement anymore. It's about ensuring you can sustain your lifestyle for potentially 2 or 3 decades.
Right, and that's pretty daunting. I think a lot of people feel that pressure. You know, with inflation rates being what they are, it can feel like your money is just not going to stretch as far as it used to. I've heard some staggering statistics about how many people are actually worried they won't have enough saved.
Exactly. A recent survey found that nearly 60% of people over 40 are concerned about their retirement savings. And that's understandable. When you're in your 40s and 50s, you might also be juggling kids, college funds, caring for aging parents, and still trying to put money away for your own retirement. It's a lot to manage.
And then there's this emotional aspect, right? It's not just about the numbers. It's about peace of mind. Many people have a real fear of running out of money. I've spoken to listeners who feel that anxiety weighing on them. It's a heavy burden.
Definitely. Money is so tied to our sense of security and well-being. For many, retirement is that last chapter where they want to enjoy life without the stress of financial strain. But when you look at the current economic landscape, with market volatility and rising costs, it's easy to see why people are feeling anxious.
That's a great point. And when you think about it, a lot of the usual advice might feel outdated. The traditional view was to just save and invest. But with changing retirement timelines and the unpredictability of the economy, people need to be strategic about how they allocate their resources.
Right, that's where the bucket strategy really comes into play. It's about dividing your retirement savings into different buckets based on when you'll need the money. So you might have a short-term bucket for immediate needs and a long-term bucket for growth.
I love that. It's like a personalized approach to retirement. But how does someone even start figuring out how to allocate their funds into these buckets?
Well, first, it's important to assess your timeline. If you're planning to retire in the next few years, you'll want to ensure that your short-term bucket is secure and accessible. Think of it as your safety net. You don't want to be forced to sell stocks in a down market just to cover living expenses.
That makes so much sense. I can imagine someone in their early 60s wanting to keep that money safe, while someone in their late 40s has a bit more time to allow for some growth, right?
Exactly. For that younger group, maybe they can take on a bit more risk in their long-term bucket, investing in stocks or other growth-oriented assets. But the key is knowing when you'll need the money.
And what about those who feel they've fallen behind on their retirement savings? It must feel overwhelming to think about creating those buckets when you're worried about just having enough.
It can be daunting, but it's definitely not hopeless. The first step is to take stock of what you have. Look at your current savings, any debts, and your expected retirement expenses. Then, start small. Even if you can only allocate a little bit into a long-term bucket, it's a step in the right direction.
That's so encouraging. I think a lot of people get stuck in analysis paralysis. They feel like they need to have everything figured out before they make a move. but taking even small steps can lead to big changes over time.
Absolutely. It's all about building momentum, and as you see your savings grow, it can inspire you to keep going. Plus, with the right plan in place, you'll be able to adjust as needed. Maybe even add more to that long-term bucket when you feel more secure.
So aside from just the numbers, are there emotional benefits to implementing this kind of strategy?
Definitely. Knowing you have a structured plan in place can alleviate a lot of that anxiety we talked about. It gives you a sense of control over your financial future. And when you have that clarity, you can focus more on enjoying life and less on worrying about what's next.
I love that perspective. It's like creating a roadmap for your future. But what happens if someone reaches a point where they need to adjust their buckets?
Life is unpredictable, so flexibility is key. Maybe your situation changes, or you have unexpected expenses. That's where having a clear understanding of your priorities can help you shift funds between buckets without panicking.
And I imagine having a financial advisor to help navigate those changes can be invaluable.
Absolutely. A good advisor can help you review your buckets regularly and make adjustments based on market conditions or personal changes. It's about having that partnership to keep you on track.
So it sounds like the bucket strategy isn't just a one-time setup. It's an ongoing process.
Exactly. You want to review it regularly, especially as you approach retirement. It's all about being proactive rather than reactive.
That's such a great principle to live by. So with all this in mind, what are some core strategies people can start implementing now to set up their own bucket strategy?
Well, let's dive into that. So when we talk about the retirement bucket strategy, it's really about creating a structure that helps you manage your investments through different stages of your retirement.
Right, and that structure typically divides your assets into three main buckets: short-term, medium-term, and long-term.
Exactly. The short-term bucket is meant to cover your immediate expenses, right? Typically, you want this to hold cash or very low-risk investments.
Like money market accounts or short-term bonds, right? Something that's easily accessible without much risk of losing principal.
Yes. The idea here is that you'll draw from this bucket for the first few years of your retirement, ensuring that market fluctuations won't impact your daily living expenses.
So how much should someone have in that short-term bucket?
A good rule of thumb is to have about 3 to 5 years worth of living expenses saved up in there. This provides a cushion, so if the market takes a dip, you're not forced to sell other investments at a loss.
That makes sense. And then we have the medium-term bucket. What's the goal for that one?
The medium-term bucket is for expenses that you'll anticipate in the next 5 to 10 years. This could include things like travel, home repairs, or even healthcare costs.
So it's still relatively safe, but you can afford to take a bit more risk, right?
Exactly. You might consider a mix of bonds and conservative stocks here. The goal is to earn a better return than what you'd get in the short-term bucket. But you still want to manage the risk.
What about the long-term bucket?
The long-term bucket is where you can really let your investments grow. This is typically for expenses that you won't need to tap into for 10 years or more.
So this is where you'd put things like stocks or real estate, right? Higher risk, but also higher potential returns?
Precisely. You want to focus on growth-oriented investments here because you have time to ride out the market's ups and downs.
I like that approach. It gives people a clear vision of how to allocate their resources.
And it's important to regularly review and adjust these buckets as needed. Life changes, and so do expenses.
Yeah, like if someone plans to move, or if healthcare expenses increase as they age.
Exactly. You might need to shift funds from your long-term bucket to your medium-term bucket, depending on those changes.
And that's why having a flexible plan is so crucial.
Right, so let's talk about some practical steps to implement this. First, I'd suggest calculating your current expenses to figure out how much you need in that short-term bucket.
And then, once you have those figures, you can start building out the other buckets based on your timeline and comfort level with risk.
Yes! Another step is to periodically reassess your investments. Market conditions and personal circumstances can change, so it's good to check in on your allocations regularly, maybe annually or biannually.
And what about setting up automatic contributions?
Great point. Setting up automatic transfers to these buckets can simplify the process and help you stay disciplined.
So you could automate contributions into your short-term bucket for immediate needs while also directing funds to your long-term bucket for growth.
Exactly. It creates a habit, and you're less likely to spend that money on something else.
What about using financial tools or apps to help with this?
There are some fantastic apps out there that can help you track your expenses and savings goals. Some allow you to visualize your buckets and see how your investments are performing.
That sounds really helpful. It could make it easier to stay on top of everything.
Definitely. And remember, it's not just about the numbers. It's about aligning your financial strategy with your life goals.
Right, like if someone dreams of traveling or moving to a new city in retirement, that affects how they allocate their buckets.
Exactly. It's about making your financial plan work for you, not the other way around.
So let's say someone has their buckets set up. What common pitfalls should they be aware of?
Well, one major pitfall is underestimating how much you'll need in that short-term bucket.
Oh, for sure. If someone doesn't account for unexpected expenses, that can really throw a wrench in their plans.
And then there's the temptation to chase higher returns in the long-term bucket without considering the risk involved.
Yeah, that could be dangerous, especially if someone is close to retirement.
Right. It's all about finding that balance and sticking to your strategy.
So adjusting your plan as needed, but also staying true to your long-term vision.
Exactly. And remember, it's perfectly normal to feel overwhelmed at times. Just take it step by step and don't hesitate to reach out for help if you need it.
That's a great reminder.
So those are some immediate steps you can take. Now let's bring everything together in the outro.
So, Alex, let's dive into some of those common pitfalls people face when they're using the retirement bucket strategy.
Absolutely, Jordan. One of the biggest mistakes I see is people not fully understanding their time horizon. They might think, oh, I'm retiring in 5 years, so I should just focus on short-term investments. But that can lead to missed opportunities for growth if they're overly conservative.
Right, and it can be easy to get caught up in the fear of market volatility, especially with so much noise around us.
Exactly. I had a client once, let's call him Steve. Steve had a solid plan but got really nervous when the market dipped. Instead of staying the course, he moved a significant portion of his investments to cash.
Ouch. That's a tough position, especially because he likely missed out on the recovery that followed.
Yes, and that's the danger. If you react too quickly to market fluctuations, you could be locking in losses or missing out on gains when the market rebounds.
So it's really about having a clear strategy and sticking to it, right?
For sure. Another common mistake is underestimating expenses in retirement. People often forget to factor in healthcare costs or unexpected home repairs.
Oh, definitely. Those can add up quickly.
I worked with a couple, let's call them Maria and John. They thought they'd be fine with their retirement savings, but they didn't consider the rising costs of healthcare. A few years in, they were scrambling because they hadn't budgeted for those expenses.
That's a tough realization. It must have felt overwhelming for them.
It really was. They had to adjust their lifestyle significantly, which could have been avoided with better planning. It's crucial to have a realistic view of what your expenses might look like in retirement.
And it's not just the big ticket items, right? Small, everyday expenses can sneak up on you too.
Absolutely. People often forget about things like travel, hobbies, or even just dining out. Those smaller costs can add up and impact your overall budget if you're not careful.
So, what are some signs that someone might be making these kinds of mistakes?
Well, if you find yourself constantly worried about your investments or feeling like you need to make changes based on market news, that's a red flag. It shows a lack of confidence in your strategy.
That makes sense. And what about when it comes to setting up those buckets?
A common issue there is not having enough differentiation between the buckets. For example, if someone puts too much in their short-term bucket and not enough in their long-term bucket, they could end up with a shortage later on when they need funds for things like long-term care or unexpected expenses.
So they might think they're being cautious, but it could backfire, right?
Exactly. And then there's the issue of not reviewing the plan regularly. Life changes, and so should your strategy. If you're not adjusting your buckets as your needs evolve, you could be putting yourself at risk.
That's a really good point. It's like that old saying, failing to plan is planning to fail.
Exactly. And on top of that, a lot of people don't have a backup plan. What if something unexpected happens? Your strategy should include contingencies for things like market downturns or increased expenses.
So it sounds like a flexible approach is key.
Yes, having that flexibility can make all the difference, And then there's the tendency to ignore tax implications. People often forget that withdrawals from certain accounts can impact their tax situation significantly.
That's a big one. They might think they're in a low tax bracket, but then end up getting a surprise when they start withdrawing funds.
Right, it's essential to plan those withdrawals carefully and consider the tax impact on your overall financial situation.
And what about the emotional side of things?
Great question. Emotions can really cloud judgment. If someone is too focused on short-term losses, they might make impulsive decisions that harm their long-term strategy.
It's almost like you need to be your own financial therapist sometimes.
Exactly. Having that emotional discipline is crucial. It's also helpful to have a financial advisor who can provide a more objective perspective when you're feeling anxious.
So it sounds like recognizing these danger signs early can help avoid the fallout later.
Yes, and it's about creating a proactive mindset. If something doesn't feel right, don't hesitate to revisit your plan.
So if someone realizes they've fallen into one of these traps, what are the steps they can take to get back on track?
Start by taking a step back. Review your overall financial picture. Look at your buckets, your expenses, and your asset allocation.
And maybe consult with a professional if it feels overwhelming?
Definitely. Having an expert guide, you can help clarify your situation and outline a plan to adjust your strategy.
And it's never too late to make changes, right?
Absolutely. Even if you're a few years away from retirement, there's always time to correct course and ensure your financial future is secure.
So those are some immediate steps you can take. Now let's bring everything together. So with everything we've discussed about the retirement bucket strategy, it's clear there are some practical steps listeners can take to really get the ball rolling.
Absolutely, Jordan. The first thing I'd suggest is to start by assessing your current financial situation. Take a good look at your income, expenses, and existing savings. It's like taking inventory before you start packing for a trip.
Right. And for those who might feel overwhelmed, breaking it down into smaller steps can really help. Maybe start with a simple spreadsheet or even a budgeting app. There are some great ones out there, like Mint or YNAB, which stands for You Need a Budget.
Those apps can really help you visualize your cash flow, and they often provide insights into your spending habits. Plus, it's a good way to keep track of your short-term and long-term savings goals.
Exactly. And while you're at it, consider setting up a separate savings account specifically for your short-term needs. This can make it easier to manage your funds and keep them distinct from your long-term investments.
Another immediate action is to prioritize your expenses. List them out and categorize them into needs versus wants. It's surprising how much you can find to cut back on when you really analyze your spending.
Oh, for sure. And I think it's important to remember that this isn't about depriving yourself. It's more about making smart choices that align with your financial goals.
Definitely. Once you have a clearer picture of your finances, you can start to build your buckets. For short-term savings, aim for about 6 months' worth of expenses. This should be easily accessible, like in a high-yield savings account.
And for the long-term bucket, consider looking into investment options. You might want to explore index funds, or ETFs. They typically have lower fees and can provide good diversification.
Yes, and don't overlook retirement accounts like IRAs or 401ks if you have access to them. Maxing out contributions, especially if your employer matches, is a fantastic way to grow your long-term savings.
And if you're new to investing, there are user-friendly platforms like Robinhood or Acorns that can help you get started with small amounts.
Right. And speaking of starting small, even if you can only contribute a little at first, it's the habit that's most important. Over time, you can increase your contributions as your financial situation improves.
And building that habit is key. Consider setting up automatic transfers to your savings and investment accounts. This way, you're paying yourself first, and it becomes part of your routine.
That's a great point, Jordan. Also, consider reading some books on personal finance and investing. The Total Money Makeover by Dave Ramsey is a classic, and The Simple Path to Wealth by J.L. Collins is another excellent resource that breaks down investing in a straightforward way.
Those are excellent suggestions. And if you're more of a podcast listener, there are tons of finance-related podcasts out there that can inspire and educate you on various topics.
Absolutely. Engaging with these resources can help reinforce your knowledge and keep you motivated. And don't hesitate to seek out a financial advisor if you feel you need personalized guidance.
Yes, having someone to bounce ideas off can be incredibly valuable, especially as you navigate your financial journey.
Lastly, I think it's important to regularly review your strategy. Set aside some time, maybe quarterly, to check in on your progress. Are you sticking to your budget? Are your investments performing as expected?
That's such a good point. This isn't a set it and forget it situation. Life changes, and your financial strategy should adapt too.
Exactly. And if you ever feel lost or unsure, remember that it's okay to ask for help. The financial landscape can be complex, but taking those first steps can lead to greater clarity and confidence.
So those are some immediate steps you can take. Now let's bring everything together.
So, as we wrap things up, let's revisit a few key takeaways from our discussion on the retirement bucket strategy.
Yeah, it's really all about understanding how to balance your short-term and long-term financial needs, right?
Exactly. First, having that short-term bucket can give you peace of mind, making sure you have enough liquidity for immediate expenses, while your long-term investments can focus on growth.
And remember, it's important to regularly reassess these buckets. Life changes, and so do your financial needs. Keeping an eye on your strategy ensures you're always aligned with your goals.
Right, and diversifying your investments within those buckets can really help manage risk. You want to be prepared for different market conditions.
Oh, and don't forget about the tax implications. Planning for taxes in both buckets can save you a lot in the long run.
That's a great point, Jordan. It's all about being proactive rather than reactive when it comes to your retirement planning.
And I think the biggest takeaway is that it's never too late to start thinking strategically about your retirement. Even if you're already in your 40s or beyond, there's so much you can do to secure your future.
Absolutely. Just take those first steps, and you'll be amazed at the progress you can make.
So, if you found this information useful, please consider liking this episode, subscribing to our channel, and sharing your thoughts in the comments below. And if you know someone over 40 who could benefit from this, share it with them.
Yes, your feedback means a lot, and we love hearing from you.
And next time, we'll dive into spousal IRAs and explore the benefits for non-working partners.
That's going to be an interesting discussion.
Definitely. Thanks for joining us today.
We look forward to having you with us again.
See you next time.